Welcome to the monthly market update. I'm your host, Craig Fuller, here with Anthony. Anthony, what's up?
I'm doing good. How are you doing?
I'm great. I'm great. This one is actually being broadcast live on LinkedIn,
Awesome.
Facebook, and a YouTube screen near you.
A YouTube. Hello, YouTube.
Yeah, which is pretty ubiquitous these days.
Yeah.
So excited to get back into the monthly market update. It is the end of the month, so we did get the September one done. It's been busy, but excited to look at where things are happening. So lots of fun stuff to talk about. Real quick, I'm Craig Fuller. I'm the CEO and founder of FreightWaves. Going to dive into the freight markets. My expertise is really deep into trucking. And then Anthony's going to talk about the economy.
Yes.
And so your background, you're an economist. You were a materials economist?
I was briefly a housing construction. I've done economic consulting for a variety of industries in the manufacturing sector, also on the retail side. Just living the corporate economist life.
Oh, that sounds really exciting.
I know.
I bet you're thrilled at cocktail reception.
You couldn't imagine.
So a little bit about FreightWaves. We're building a world-class community. Some will say we have one. Some will say we're continuing to build it. Regardless, you're here. We're excited. We use data and technology to understand, analyze, react, forecast, and de-risk the market. So that's a lot of fun stuff here. A little bit about FreightWaves. We've got 25, actually over 30 now, full-time reporters. And we take in fundamental data from the market, really billions of dollars worth of transactions. We aggregate, anonymize it, and then we try to explore and analyze what's happening in the freight market so that you, our listeners, and our participants in our data sets, or participants that are impacted by our data sets, can understand what's happening. And ultimately, it's all about tribal knowledge, which is really about experience and driving data to understand how things intersect. So we're going to go through a lot of stuff today. We're going to keep it really, really high energy because we like that. Talking about a subject like economics, you got to keep the pulse alive. But we're going to go into the freight economic performance, talk about, well, really, we're almost through the second half. I mean, today is the last day of the third quarter. Right. So really just go through the rest of it. We're going to talk about trends in e-commerce as well as retail. Huge. We're into peak, man. We're about to move into that retail peak, so we can dive into that. Talk a little bit about recession fears, the global economic slowdown, and then talk about interest rates.
Well, if there's anything more interesting than economics, I think interest rates. It might be a close second.
Well, I think it would be interesting. It would be uninteresting in a normal world, but we're in an unnormal world. Where actually interest rates are sort of exciting.
It's a headline item.
It is. Who knew? So, Anthony?
Yeah, so on my side, I'll be talking about manufacturing for durable and non-durable goods. We had a little bit of a surprise on the durable side when we're looking at industrial production and really diving into the state of the consumer and some of the trends that they're seeing.
Now, I don't want to spoil it, but are you excited about the surprise?
I was excited. I was surprised and excited with the manufacturing thing. I was excited.
Could it be that the freight data has been telling us that the market has been coming back?
It is, and I think we'll see some of that, but I think my theme will be cautiously optimistic.
Well, I'm far more optimistic, but I roll that way, man. Yeah. It's either doom and gloom or boom and bust.
No middle. Okay.
No, I'm bipolar. Okay. So I go either side of it.
I respect it.
So, but the good news is I'm really, really bullish about the fourth quarter.
Good.
And I'm bullish and lots of data to support that. Particularly on the trucking side. Now, global freight has certainly seen a slowdown. We'll dive into that in a few minutes. But but as it relates to the domestic freight market, I think we're seeing really, really good signs. And I'm basically going to talk about where we're at. I mean, really moving in September. Volumes are as strong as they were in June. And the other thing that's happening is that capacity is tightening across the market, particularly in certain regions, which is actually making some of the end of the quarter numbers look pretty good. I believe that a lot of the larger carriers, as they look at earnings cycles, will actually post pretty good numbers compared to what people thought they were. I'm bullish, and I'm bullish because I think most of the markets capitulated. I mean, if you look at where we were 3 months ago, people were more on the doom and gloom side. Certainly we were in middle of the summer, but about end of July, things look they were really, really strong. And what's really nice about that is that has actually continued to be reinforced by the data.
Right.
Freight data looks really, really strong. And then as you've teased, the economic data is also indicating some expansion is there.
Right.
So pretty pumped about that.
So yeah, just jumping off here. So looking at industrial production, as I mentioned, there was a surprise monthly gain. It was up 0.6%. Only bad thing here is still down on a year-over-year basis. So as I mentioned, still cautiously optimistic. So when we're looking at industrial production, we're looking at manufacturing as a whole. And when we see that that downward motion on a year-over-year basis, that's going to just kind of lean to capacity just not being as tight as it was peak 2018. But we're going to zoom in here on the next slide here. But this is just the overall high view of it all on a year-over-year basis.
I know what OTRI is, which is the tender rejection index, which we track as a fundamental data set that tracks rejections. What is this? It's industrial production. What is the DMAN?
So this is looking at durable goods manufacturing. So things that have a shelf life of 3 years or more. So this did jump up. So we're looking at the year-over-year growth on it. So it's down. But if we were to switch this to month-to-month, this would be up on a month-to-month basis. So
you're looking at a pretty tight correlation between the rejections and the industrial production.
We are, we're seeing a pretty cool correlation there. And I think in the next slide, as you mentioned, we do see. So this is essentially it kind of zoomed in, but now we're looking specifically at van outbound tender rejections. So and looking at core durable goods new orders. So
what's the difference between a core durable good orders?
So core is going to take out transportation, so excluding transportation production.
Okay.
And so this is going to be things like aircraft parts and things like that. So a lot of those transportation production items are pricey and can be sporadic. So then it kind of throws off the underlying trend. So
the airlines like the Boeing Max jet, would that be, that's not in core, right?
That's not in core.
That's not in core. So like things like a washing machine, a TV,
everything from toasters,
cell phones.
Right.
Who really buys a toaster?
I don't know. We need toaster ovens.
We do. Like, when was the last time you went out to buy a toaster?
It's been a while.
Yeah, for me too.
It's been a while. But we're seeing, so one of the things that we're seeing is nice bump up in new orders. So I love new orders. I love it because it gives us an idea of what's going to happen, because new orders means production, and then production leads to shipments, and then shipments means increased freight activity. And so we can already see how that nice close correlation was when we had a dip down in new orders. Also means a slight dip down in the overall production. So when we have that, that means capacity is really kind of get a little bit looser. And then we can kind of start to see where future production is going, where shipments are going. So that's one of the things I really, really appreciate when we're looking at the overall trend for new orders. But I think we just jumped up a couple of slides.
Yeah, but I don't know, Marianne, when you moved it, we didn't move the production, right? I think that screen moved for some reason.
It's okay.
Okay, so we're going to stay on this. So sorry about that. We moved computers because that thing was like hogging the whole desk. So we apologize for those that are listening in. So getting deeper into this, we look at the big surge at the mid-September in terms of the van tender reject. Is that more of an anomaly related to weather?
Some of it can be. Also, some of it can be seasonal.
Okay, so we see it sort of reset back, right? So we're back to where we were. Okay, so if we move into non-durable manufacturing, what's happening here?
And so that's one of the ones where I'm excited about as well. So for non-durable goods, so obviously things that have a shelf life less than 3 years. So this is not only looking at food and beverage, but also raw materials. So this month we saw a nice bump up in non-durable goods manufacturing. And we saw that as a whole, that there was also increases for, I think it was plastics and rubber products. So I was talking to one of our market experts kind of because I'm not deeply in freight, deeply in economics, and I'm still learning. I can't believe how much I've learned in my time here about freight. So I was talking to one of the market experts with shipping, and he was telling me about some of the seasonality with raw materials, things that become final plastic goods like tires and things like that, and how sometimes they have to go on reefers. And so making that correlation and seeing how the rubbers and plastics really jumped up. And this last month of data, along with pretty decent trends coming from food and beverage, it really shows a nice correlation with our refrigerated outbound tender rejections. And so that's really kind of telling us that there's a tightening capacity when we see that increased production and those increased shipments going out. And the other great thing is that you can even throw this up against the PPI, Producer Price Index for general freight trucking, and we see that spike up in the PPI as well. So we can really apply, then that's one of the things I love about Sonar, because we can apply these comparisons across the board and really kind of get confirmations.
Now, moving into getting specifically into the non-durable manufacturing data, is it just that people are eating more, or is it what is causing? Is it the raw materials? Like, what's causing these increases?
So it could be. So this month wasn't so much for food and beverages, but for more raw materials. So we did see a big.
So I mean, look at construction, because the construction was way up. I don't know if you cover it later on.
Yeah.
But one of the things that was really encouraging was new housing starts.
Housing starts. Yeah, we're going to get into that, and so that's one of the other aspects of when we're looking at non-durable goods. So just as you called it, we're going to start looking at residential construction spending. So this is more so on the consumer side. We're going to get into housing starts right after this, but looking at construction spending is still below the last year's pace, slight bump up in the month. But the biggest thing is that builders are still confident. And although there are still fundamental issues within the market, even though mortgage rates are still historically low, there's a strong demand for these homes, as we'll see here shortly. But the big thing is like there's limited lots, limited labor. Labor's so tight here, and they are really, really struggling to find help and be able to build these at the pace that the supply is demanding.
So there's obviously labor shortage is a problem,
right?
Particularly with the folks that work in construction, also work in trucking. But you also, it seems like, land in some of these markets that are growing really well. But there has been a shift of late where people are leaving these denser populations, whether it's the tax changes or just the cost of living in places like California and the Northeast. They're actually moving.
Right.
I mean, I see it in my life. I'm sure you know of people that have relocated. I mean, you yourself relocated, but it seems like there is a move to places that don't have the as tight of land and certainly don't have the uncooperative tax environment.
Right, and that's a huge part of it. And I think a lot of it's going to start coming as we have millennials coming into that prime buying age, although they have their own host of issues with college, student debt. But they tend to, millennials, I don't like to overgeneralize generations, but they tend to move as a monolith. So when I think earlier, mid-2000s, we saw millennials really moving to these major metros. Like we see them moving all in a herd to Seattle, all in a herd to Portland, Dallas, Atlanta, these big metros. And like you said, now we're starting to see people kind of getting out into the suburbs. And really, I think seeing comparatively lower cost of living when we're looking at states maybe in the Midwest that, or maybe you can work, telecommute, and really.
There has been, and then Bloomberg published this. We actually published something a while back. I think it was 2 years ago. Was this concept of deurbanization, which is as millennials are now have enough disposable income or have some disposable income, if they relocate outside of these big cities, they'll actually do quite well, especially with telecommuting and the ability to work almost anywhere. It means, and frankly, not just work remotely, but find jobs where you can work for companies that are benefiting from lower cost of labor, lower cost of an environment, and they're moving to these different markets.
Exactly.
I mean, we see it in Chattanooga. Out of 140 employees we have here at FreightWaves in Chattanooga, 45 of those are from out of state.
Right.
So we're seeing it, and it's interesting that people are starting to do it. So I think this certainly is encouraging, and perhaps we're seeing it impacted. I think the flatbed operators will certainly benefit from better construction spending. Definitely. Do you think moving into next year that the construction market's going to stay pretty strong?
I think the construction market is going to be relatively strong. I think that demand's going to stay there, even if, so worst case scenario, if we were to have a recession, I think we wouldn't see in the next recession, whenever that is, I don't think we'll see a huge drop down in demand for housing. And I think this is a little running theory I have in my head here, but in the last recession, it was 08, 09. It was primarily that housing bubble.
Mm-hmm.
And I think when we have that 08, 09 recession, we have tons of millennials. That's the only recession they know. Not a lot of them remember 2001. They don't really remember the dot-com bubble. And so their idea of recession is essentially what is housing. So I think we have a herd of millennials that are just waiting to hear the R word and just jumping in the housing market. So I think that demand is going to stay pretty strong here. And something that we're seeing, and I think in the next slide here, we're going to have housing starts, which is up, that just jumped 12.3% for the month. And we have that compared with the HPSI, so that's the Fannie Mae Home Purchasing Sentiment Index, kind of seen as a not only a pseudo consumer confidence, but really shows the demand for housing on the consumer side.
Yeah, it looks like housing starts improve housing sentiment. Is sentiment follow housing starts, or does it looks like which one? It looks like sentiment leads housing starts.
Sentiment does lead housing starts, but the thing is, there can be demand sides. So I mean, supply side issues like we're mentioning for lot availability. There can be issues with, like we mentioned earlier, labor. So sometimes there's that imbalance of there is not that supply to meet that demand. And that is one of the most aggravating things as an economist is when you see that demand there, but supply isn't quite able to.
Isn't able to catch up, especially something. I mean, a lot of markets are going to these, restrictive zoning laws.
Mm-hmm.
You have places that are preventing you from increasing rents and things like that as they sort of resolve it. That doesn't help,
right?
Because it doesn't create any sort of speculative investments in these things. So we'll see. I mean, I think it's interesting because you did mention something about housing, and the next recession probably wouldn't be as impacted. One of the things that's interesting is just the demographic and the age. Mm-hmm. Is that in that 2008 and 2009, 2007, 2009 period, it was actually one of the, from a demographic standpoint, that was one of the smallest populations in terms of period. So like, as you move into the expansion that we have in the 2000s, is that a lot of people didn't go out and buy homes. They didn't go out and build them. They were renting. And now they're moving back into houses.
Right.
And so that fundamentally is driving a lot of this.
And so one of the other charts here, as we're keeping on the consumer side of things, is digital momentum. We saw a drop in consumer confidence. One of the largest drops. We usually there's two main headlines. There's the Conference Board and the University of Michigan. Conference Board did see a pretty significant drop. So I pulled up here the digital momentum for global recession fears, and so we can see throughout the month there have been quite a few spikes. But the good thing is that although that could be on the minds of consumers are in a good position. They're in a good environment.
Now you've got Brexit issues. Is this so? This is global recession. Is really related to the UK,
right?
I mean, it seems to be a big driver of it. And then you also have trade imbalances and trade issues. But one of the things that's that we may get into is the impeachment process, whether it actually goes through and whether there's anything that comes of it. It will serve as a distraction,
right?
And I've said it before: distractions in a normal world, they would be a good thing.
Yeah.
Who knows? If we don't, but maybe I'll say it again. Maybe that keeps us from having any sort of trade policy changes during this period. So getting into the freight market, I want to talk a little bit about volumes, because if you're going to draw any conclusions about the market, you have to take capacity out of the conversation to understand if the freight market is increasing volumes or decreasing. So one of the things we do is take and look at outbound tender volumes, which are volumes of freight transactions requested from shippers to carriers. And one of the reasons that I'm really, really bullish about the market is the fact that this tender volume index from really the third week of July, once there was that crossover, and you can see it on July 22nd, it's near the left side of the chart, you can actually see that once those cross, they haven't crossed again except during the holidays. So Labor Day is going to be a little bit of fluctuation, but they've stayed. We've seen a big gap between 2009 2018 numbers. What's really encouraging about that is that we are not seeing any real significant compression in volumes or the 2019 numbers start to chase the 18 number, which should suggest that volumes are frankly stronger in 19 than 18. And it certainly plays, if you mentioned housing starts, manufacturing, retail, those things are getting better reports than we expected. And because of that, things look encouraging.
Right.
Moving into, a little bit of impact. I think this is really interesting because you're looking at the impact of the hurricane and really looking at how this is tracking Jacksonville, Florida, and Savannah, Georgia. And looking at the orange line is Jacksonville, the green is Savannah. We saw, and take those normal sort of holiday fluctuations out of it, what you saw is that Jacksonville's volume significantly dropped off in the reaction to the hurricane. Savannah actually shot up and has actually been done better than the rest of that. But you did see that imports stalled during that period. Moving in, and we're actually getting into this exactly, is that you saw a pretty big shutdown during the pre-run up to Dorian, but then you saw Savannah actually do better on the outbound. And so Savannah's market share increased, Jacksonville's did not. So we're seeing that the market in Savannah is recovering. It probably means a lot more freight sort of moving out of that market now than was before. Looking at going into Florida is that basically, when we look at what happened before that, is that, if you think about the run up in the hurricane, you have a lot of freight that is stationed ahead. You have a drop off in freight demand during the hurricane because they don't want to put trucks into harm's way. And then after that, the market sort of recovers. Now, the good news is the market, because the hurricane did not really dramatically impact really anywhere except for some flooding, you didn't see significant, obviously Bahamas was impacted, but I'm talking about the domestic market. You don't see significant impacts in terms of long-term sort of freight impacts to the market in terms of what's happened. I want to talk a little bit about sort of the direction of rates, because this is something that is really interesting. This is a comparison of DAT's spot national long-haul rates. And so again, it's different than the rate view product that DAT posts a lot about, because rate view takes not rate view, I'm sorry, the trend lines takes an aggregated national average. This is actually on a lane by lane basis, but it's a national long haul rate. So it's looking at on specific lanes that represent the national benchmark. How did they compare to on a year over year basis? And it gives us a really good baseline because there's no weighting concerns on what gets weighted in there and what length of hauls get weighted in there, because you look at the same lanes. And what's interesting is we saw a really big run up in the month of June. A lot of that was just normal seasonality, is that carriers know that when June comes, they can get higher rates. And so we saw tender rejections sort of increase, but not to the level. So they started moved a little bit they're moving directionally in the same direction, but tender rejections they didn't look like they supported the higher significant sort of surge in rates. And we've now seen those spot rates come back down. And so it looks like that the sort of midsummer surge that we saw, or early summer surge that we saw in June, was nothing more than a month sort of a surge. And we're not seeing any indications that you're going to see high spot rates at the end of the year. So I would say that I'm bullish as it relates to volume, less so as it relates to rate.
Gotcha.
I don't think we're going to see significant rate increases. Nothing suggests right now in tender rejections that trucking rates are going to really, really shoot up in the spot market. Moving into just sort of looking at how we're comparing this year to next year, and I think you can see that in this chart. The white rate data, the white chart, is actually 2019. The orange would be 2016 to 2017. And the green is 2017 to 2018. So we're looking at the last couple of years where, if you sort of look at this from where we're at, we're seeing a little bit of pressure that follows some normal seasonality, but not as big as we saw in that 2016 to 2017 sort of push. So we're going to see something that looks more like we're back in 15 to 16. Now, remember, 15 to 16 was considered a freight recession. It looks like we're sort of back to where we came from. Now, what's not in this number is the cost increase the carriers have borne. So that means driver wages, that means higher fuel cost. All those things are not factored in that. So the carriers are not doing as well as they could otherwise be if rates had maintained any level of pressure. Moving into sort of how does the rest of the U.S. look, we see a little bit of seasonality or a little bit of increase in certain regions of the U.S. The Northwest is doing better than it's been doing. A lot of that is related to some of the crops that come out of the Northwest right now. So apples are a really big deal. Cherries are a really big deal this time of year. I think cranberries move out of that area of the country. And so you do see some increase in terms of demand out of the Pacific Northwest, but it's doing better. And so is the Midwest. And so a lot of those increases appear to be related to agriculture. And so, a lot of this happening. And then also the GM strike, which we're going to talk a lot about here in a second. Now, the Southeast there hasn't been a huge amount of pressure on the Southeast right now in terms of capacity.
And I think there was some pretty big news Friday with the trade deal with Japan. That's really going to kind of, I think, open up a little bit more agricultural for our farmers here.
Do you want to talk about that?
Just I think real quick, that's going to open up a little bit more for the agricultural side. I know there are a few more items that were going to be included. I know primarily beef, pork, I think are going to be a couple of items that were listed. And so I think there is going to be some upward pressure on prices as that market is kind of opened up, more demand.
And why is that? I mean, Japan's been a pretty closed market for many, many years.
It's been closed, and I think the Trans-Pacific partnership that was terminated a couple years back, that really kind of put the farmers in a bad position, and I think this is going to eliminate some of that.
Yeah, looking at looking at the Northwest market, you've got September is the start of apple and potato season in Idaho, places like Idaho and Pacific Northwest. We talked about apples. And also the Yakima Valley.
Sounds about right.
Is that right? Is the largest national producer of apple and also hops. And so you're seeing that agricultural markets are having an impact on Pacific Northwest. Moving into the General Motors, I mean, GM, I think this is a really interesting chart because it actually shows a very sizable and unusual surge in activity. And one of the things that you would normally expect is just a slowdown in volumes out of a market. But because the auto plants are such a significant customer, and not only General Motors and Ford being customers of freight, and GM in this case, but also their suppliers are significantly users of freight demand and freight capacity. When GM went on strike, it actually has a pretty substantial impact on everything in that market. And so you're looking at rejection rates have spiked. In these major auto production plants. I know that we've covered some stories of some trucking companies laying off. Mm-hmm. I know that there was a trucking company earlier this year that actually was gone bankrupt related to GM moving its. So you're going to see a significant amount of pressure for those carriers that haul a lot of automotive as these issues sort of cycle through. Now, one of the things we are seeing is that even these, so carriers broadly are honoring the picket lines, which is basically, this is odd because not every carrier is unionized, but even those that aren't unionized don't want to cross the picket. They want to put their drivers in harm's way. Right. And they don't want to be stuck in dealing with these disruptions. Moving into one of the things that we've talked about is the impact of the Saudi oil prices and the Saudi attacks that happened a few weeks ago. If you looked at when the fuel markets opened, oil, both the Brent contract and the WTI shot up double digits. Brent shot up 20%, but that didn't sustain. It didn't last. It was really a 2-day thing. We actually had said if this were sustainable, it could go up as much as 60 cents a gallon. Didn't happen, thank God. It did reset. But what we did see is that rack prices shot up initially and then sort of stabilized at a higher level than they were before. But that DOE national index didn't really show up in last week's data, but this week's data, the average, it is showing up because, or 2 weeks ago, I didn't show up last week because it was able to assess those higher rates. And so we're able to see sort of how that works. And then you can see it also in the data in terms of the fuel spread. You saw the Saudi attacks, the spread between retail and wholesale. There was a significant amount of compression and then it sort of shot back up. So what that means in terms of the spread is that the price delta between what carriers that are on wholesale fuel are buying and what they're able to get back in retail fuel surcharges started to narrow. And because of that narrowing effect, it will have some impact on some carriers' P&Ls. But what we're seeing now is that it's come back to a level not as high as what it was before, but certainly back to 95 cents, which is closer. Moving into intermodal container volumes, I think this is really interesting because you're talking about how trucking and intermodal are comparing. So as trucking really got pretty tough this year, we've seen sort of the tale of two cities. Trucking volumes are up 4%. In terms of flat car, you look at the intermodal trailer, so TOFC, trailer on flat car, is down just 4%, but it's still down. So the railroads are struggling more than the trucking companies are this year. And then I think this is really, really interesting is that flat car volumes, when you look at what's happened in terms of, so actually intermodal with the intermodal containers, and then trailer on flat cars is actually down 19%. So pretty significant impact in terms of what's happening overall. Moving into the port container market share, this is really showing the percent of what each market represents across the U.S. LA, the Los Angeles basin, whether you're talking Long Beach or LA, is a major, major producer of freight volume. And it's as much as, in terms of import activity, as much as about 30, in this case, about 34 or 35%. We've actually seen that, and it's very, very closely tied to China and very closely tied to Asia. What we're seeing is that the LA volumes are sort of stalling out. We're not seeing any growth in volume really in Southern California area. But we're seeing some of these secondary ports actually gain share. So places like Savannah, Georgia, and Houston, Tacoma are actually gaining in terms of volumes, while the bigger port cities are actually losing some volume relative to where they were last year. Right. So really interesting thing to watch as we move into the next cycle. So just a summary of where things are at is that volume continued to show strength against 2018. It's 4% up in September. Hurricane Dorian had an anticipatory impact to the freight market, but minor overall. And capacity tightened in September, with the Midwest and Northwest regions were the tightest, and the GM strike and fall harvest have created the biggest disruptions.
Awesome. At this point, guys, we'll go ahead and move into Q&A. So if you haven't already submitted your questions, click that Q&A button in your control panel, and we'll get to as many of those as we have time for. Question 1, is fuel cost or truckload capacity the only trigger for an increase in intermodal?
Well, fuel costs certainly, you do see a mode shift when fuel prices go up because the rail surcharge is much lower than the truck fuel surcharge. I don't think so. I think, frankly, what's happened is that shippers, when trucking rates are, look, I think at the end of the day, if you asked a shipper, and they were being completely frank with you, and you asked them, do they prefer truck or intermodal for their cargo? If all things are created equal, if the price was identical, they would go with truck. And the reason is that truck it doesn't get as disrupted with service. It's faster, first of all. It's more direct. And so I think because of that, and there's frankly less people or parties handling the cargo intra-transit, there's less chance of it getting damaged or shifted. And therefore, I think, frankly, shippers prefer truck. But where they tend to move intermodal volume is when the price when the price in trucking services have gone up. And I think what's happened is they've started to shift more demands towards truck because prices are lower. And frankly, the length of haul has a lot to do with it, is that we've also seen where you've seen a smaller length of haul related to e-commerce or other things that are going on in the market, is they're starting to think differently about that. And the other thing you have to keep in mind is when you're starting to move freight less on those sort of power lanes from LA to Chicago or LA to Dallas related to ports, and you're starting to move stuff to the East Coast, it's frankly closer to where it's being consumed. And because of that, you're unlikely to rail it as often. You may end up trucking it.
All right. And then regarding the GM slide, why did the RI only spike that 1 week and then come back down?
Well, I think it's just disruption, right? So in the case of a strike, it's effectively a black swan event. Even though it was anticipated, people knew it was happening. I don't think people thought. I mean, oftentimes these strikes come up to the last hour, and I think if you sort of ask people, everyone sort of assumes that it will be settled and resolved, no matter how. I mean, they usually do. I think something like 9 times out of 10 strikes that are called for, or at least talked about, ends up getting settled at the last minute. And then a lot of times it's a negotiation tactic. And I think what happened is that all of a sudden shippers that were sending freight there to plants realized that they had ordered these trucks well before in advance. Nobody was going to be there. Carriers are not going to put themselves into that congestion, into those markets. And so you saw a massive spike really in activity. You saw it reset because carriers started to reallocate capacity and shippers weren't asking for those loads. And that's really what happened. So I think what you effectively saw was what I call a black swan event, which was something that wasn't anticipated in advance to the degree. And that's really why you saw that short-term surge.
Okay. And with 2020 being an election year, how do you see that affecting the freight market? Do you think we'll see less purchases in Q3 as the election approaches?
You mean from is the question about retail spending? Is it 2020?
Yeah, it says in 2020. So I guess next year as the election.
But is it they're wondering what happens in the economy because of the election?
I assume it's what.
Okay, Anthony. I mean, election cycles do impact the economy, but usually
nothing too drastic. So I think with the approaching of 2020, there is a lot of uncertainty, but I think the biggest uncertainties when it comes to overall business action is going to come from what in the world is going to happen with China, because right now we're seeing individuals or businesses that aren't comfortable with investing in infrastructure overseas in China and potentially looking for other substitutions. And so I think that's really going to be a big one. Potential run-ups in order to build inventory, I think is really going to be another big one, especially as we have, I think this delay until October 15th. But I think it's so uncertain with that situation. I think that's going to be the biggest make or break moment with movement of freight more than so.
Trade. You're talking about trade policy?
Yes.
And I think the other thing is, I think you have to wonder, at least I wonder, is the rhetoric around tax changes, the way people are thinking about private equity, and you sort of have these extremes right now on the left that don't seem to, at least from an outsider looking in a normal market, would seem so irrational in terms of the reconstruction of our economy. But we've seen elections like the last one went in a completely different direction.
Right.
So I can't imagine that we would end up in an election cycle electing something that's so pretty extreme. But if it appears that Trump is going to lose the election, and you're gonna and one of the more liberal or further left candidates ends up getting momentum and appears to be winning, you may see companies start to think differently about how they deploy capital, how they start to accelerate their purchases of certain items, and start to become into a defensive measure if they really think that both houses of Congress and the presidency is going to go in one direction. I can see that happening. But right now, who knows? And we don't even know what's going to happen in 3 months from now, much less a year. I'd hate to speculate at this point.
Yeah. Great. All right. Are you seeing any significant differences between market and industry conditions impacting small versus large carriers?
Absolutely. I mean, there is a very clear delta between the larger enterprise carriers and when mostly enterprises 1,000 trucks or more, and sort of the sub 100 trucks, or the trucks that are much more exposed to spot market. There's a very clear difference. Spot rates are near the bottom. They're not showing any significant increase or pressure. Whereas it appears that the larger asset carriers are able to maintain their level of volumes in the market, or at least having some support on pricing. I don't think they'll see year-over-year increases, or at least anything of substance, but I do think there's a big difference. And then, frankly, the delta between the fuel purchases. There's a couple things going on for the larger carriers that benefit. Is first of all, they're able to attract drivers. So as the small spot market carriers are struggling more so, then the larger carriers are able to get more drivers. That driver squeeze, shortage, whatever term you want to use, is less pronounced among the larger carriers than it was perhaps last year, simply because some of the smaller carriers that have been dependent upon spot market freight are struggling to keep their drivers moving. So there is an advantage there. The second thing is that the larger carriers are buying their fuel on rack wholesale prices versus retail, which they become a beneficiary as that spread gets increases. And so we've seen that development. And then we're seeing, if you're a large retailer or you're a large shipper, you're more reluctant to pull your capacity from guys that are able to give you a ton of trucks than the guys that maybe are more transactional. And so I think what you're seeing right now is that there is a very clear difference between the larger carriers having advantages versus the small carriers. But I think that's more normal. It feels like we're back in, say, 13, 14, where you sort of saw those conditions, maybe even back to 12. I mean, normally the larger carriers do have advantages. Last year, it was the opposite. Last year, the small guys had all the advantages. The problem was they weren't long-lived. And so I think we're back to where back to the future in some ways.
Great. And do you have any predictions around fuel prices as we get closer to IMO 2020 being enforced?
This is in many ways like trying to ask me what Baylor versus Texas is going to be in terms of score. I don't know, or Oklahoma versus Texas. I don't know. I mean, I can make cases on both sides of it. Certainly, you can make a case that there just isn't enough refined marine fuel out there, and they're going to start diverting refinery capacity from the trucking market into the marine market. But we're not seeing any real fundamental shifts in the forward market, the forward indexes as it relates to fuel. There hasn't seemed to be a ton of pressure on diesel. And frankly, with the exception of this one geopolitical event, the refineries getting struck by drones, we've not seen oil. Oil is pretty flat. It's a pretty flat market. And so we're not seeing a significant acceleration in diesel prices yet. And I think the jury's still out. So I don't know. Do you have any additional commentary on that?
I think there's just not a lot of preparation.
There's not a lot of preparation, but it doesn't appear even in the financial markets that there's even a major anticipation. I mean, the question is going to be, and I think we talked this last time, is if the global economy is in a recession, are you going to see, because it's really the Europeans and in a place like Singapore that have really been pushing it, are you going to see them start to think, should we think differently about IMO 2020? Right. And I guess you can make a case that yes, but then you could also make the case that with climate change getting such attention globally, that they'd be reluctant to do that. Right. So I don't know. I don't see any indications yet that it's going to be a significant concern, but I can make a case on why it should be.
Yeah. And kind of tacking on to that with respect to IMO 2020, do you have any ideas around what the carrier impact will be for Q1 in 2020?
Well, if you're buying fuel on rack wholesale, then you actually might be a beneficiary if the retail prices shoot up. So if retail, conceptually, what happens at the rack will impact the wholesale price or impact the retail price, and it will follow. And so if you do see a significant surge, and I think some of the expectations, the EIA, which is a government agency, the Energy Information Administration, I think is what it stands for, had projected that a 25 cent a gallon increase in diesel, ULSD in diesel, which at a $2 a gallon, is effectively 12%. Right now, with fuel being, retail fuel being $3 a gallon, 12% doesn't seem to be significant enough to really move the market. Like we saw potentially that big increase in the refinery blow up. So I don't think so. I think as long as oil prices and fuel prices stay where they're at, I don't think we'll see a significant surge in retail diesel prices right now, and I don't think we'll see a significant surge in pressure. If it does take place, it's going to cost 4 to 5 cents a mile more, which, based on the conditions, is a pretty insignificant move.
And to Anthony's point about housing possibly keeping any recession minimal if one should occur, the listener says, I read last week that since June 2009, we've created 2.6 million more new households than homes started. So while we may have been overbuilding leading up to the Great Recession, we have underbuilding since, which will hopefully bode well as we lead into a maturing, slower growth economy on the back end of this expansion. Would you agree with that?
I agree with that, and I think, but the difficult thing is going to be the demand for the entry level homes, and so I think that's really where that's where a lot of the demand is coming from: entry level homes, first time home buyers to that mid priced home. And so I think even if we were enter some kind of our next recessionary trend, maybe pricing coming down on some of those homes, on those pricier homes, to make it more appealing for first-time home buyers with a lot of that pent-up demand. And I think the other big thing is competing with existing homes. So existing homes inventory has been tight just because there's such a demand, and that's been really jacking up prices as well. But I think really it's really going to come down to what happens on that entry-level price point.
That's a great point. And I think, but you are seeing some places, Miami is starting to, the housing market in Miami is actually slowing down.
Right.
Places that sort of had big speculative build seem to be slowing down. And places like New York.
Yeah.
I mean, I know 3 families that have relocated from New York to the South because they frankly got tired of paying the taxes.
Right, right.
And I having family that's young, my wife's family has some folks that are in New York. And she has friends that are in New York looking at homes. The prices they're paying, and we show them what we're paying down here, is just astounding.
Right.
The delta between what they're getting up there and what we're paying down here in the South. And I think that's going to, in some ways, that may encourage people to think differently about where they live and end up shifting to different parts of the country.
Definitely. And I think one of the fastest growing segments when we're looking regionally is the South. It's definitely the largest. And
thank God for air conditioning.
Exactly. Exactly. Mild winters.
It's still freaking 95 degrees outside.
I love it.
So I don't.
When you were talking about rates and stated that they're going to look like 2015 or 2016, are you saying that the rates will drop down that low, or any potential increases will be smaller like they were in those years? The base was increased last year and there's been some sliding back, but not all the way back to the previous year.
Well, if you go back to the chart that we showed a few minutes ago, and it's in the deck, you can see that rates have actually come back to those levels. They have lost a lot of the momentum they had last year, and they're back to the 2015, 2016 levels. And what we're seeing is that curve, if you think about the market having a curve, is that slope of increase is seasonal. You're going to have some seasonality that increases, but you're seeing that slope look much more like 15 and 16. It's a little higher than it was back then, but the slope is very gradual versus what you saw 2 years ago, and you don't see that significant surge in price. And so what that suggests is that rates are probably going to stay muted during peak. And I actually think that we're past sort of the lowest rate. I don't think we're going to see any deterioration beyond this. I think we're back at a point where, if you go much lower than this, a lot of carriers can't survive it. One of the theories that's been floated to me recently by a very large 3PL is that the digital brokers are actually keeping some of that spot rate from having any level of increase, as they're absorbing some of the potential increases, and they're just gaining share. So in a normal market, if capacity was tightening, the market spot rate would be increasing. They're suggesting that they may be absorbing some of those increases in their own margins and less take rate. I don't see any evidence of that at a significant scale. I can certainly make the case, but I don't see anything suggesting that that's actually happening in the data, but it's something to watch.
And a good question here about one of the articles that was posted on our site, actually. It says a FreightWaves article a day or two after the drone strike said, truckers fill up your tank ASAP, diesel could surge 60 cents per gallon this week. With the amount of people reading these articles in the freight industry, was there any blowback from anyone? We sent this article off to our fuel hedge team, and they have questioned the validity of where the 60 cents number was derived from. Was that from another source, or did FreightWaves predict that number with its?
Well, we were looking at the 20%, the 20% surge that happened on Sunday evening. So When the Brent market opened up on Sunday, there was a 19% immediately open surge in diesel. In Brent, which will show up in the diesel market. By Monday, it looked like that surge was over with. So I can't say, but there was a moment in time reflection of what could have happened. I don't think anybody would have missed out by filling up. If you made a mistake or if you filled up quicker, you potentially ended up saving 2 or 3 cents a gallon by the time it reset. But these are moment in time issues. That was a moment in time. It was the fastest and highest increase in oil prices since I believe the original Gulf War. In terms of a one-day surge. And so certainly at the moment that was written 2 hours after it opened, I think everybody was sort of expecting some pretty significant impacts.
Yeah. And a good data question here. Are you seeing carrier bankruptcies show up in the capacity data yet?
Look, there are certainly bankruptcies, but you have to remember that the company may be bankrupting, but the driver isn't bankrupting. And the truck may not be leaving the industry. If you look at the FMCSA data, you still see some increases in terms of truck counts. And so there's nothing to suggest that we're seeing drain of capacity in the market. We're not seeing any level of really tender rejection increases. And we're seeing muted spot rates. And so it's suggesting that even though we have higher volumes, we're not seeing any sort of significant surge.
And next question. What do you predict happens in the final mile or white glove delivery market? Is this a saturated market or will prices continue to climb? Are retailers and e-tailers struggling with capacity and or service?
I don't see anything. Certainly, we saw the Watkins Shepherd shut down from Schneider for last mile furniture deliveries. Certain types of commodities are tougher. But if you look at the rejection data or even driver employment data, other than just increasing demand, it actually appears that there is a continuing increase in driver I think people are frankly leaving the over-the-road market and moving into those short lengths of hauls, and carriers are reallocating capacity where they can make money in those short lengths of hauls. Are there what I would call capacity issues? No. Maybe at a margin in certain markets. It seems to be more logistical challenges. Companies, frankly, are starting to outrun their own logistics capacity. And that's why Amazon has built out Target is building on it. Target bought shipped for that reason. And so I think what you're seeing is that companies are thinking differently about logistics. If they are doing it, they're better prepared. I think what you're seeing is where you see supply chain challenges at these last miles is because they don't have as much infrastructure built for the changing dynamics of the customer. I think the runway was one this past week that actually stopped taking on new customers because their supply chain and logistics operations couldn't keep up with the demand.
Great. And do you expect railroads to begin increasing intermodal lane offerings?
Railroads are so focused on refining their performance right now with a precision railroading that seems to be the core focus. Will they move into when you say increase their intermodal offerings? I assume what you're talking about is either increasing the amount of ramp capacity or markets they serve, or alternatively, will they add commercial trucking fleets or chassis to their intermodal operations? They're going to continue to grow at a pace that they feel comfortable with, but certainly there's nothing to suggest that they are as focused on intermodal growth as they are on precision railroading. Right now, it seems like they're really trying to refine their business models to be more profitable, to have better on-time services than they do to be modal shifting in terms of what they're focused on.
Okay. With respect to rates, I believe your data is strictly from the spot market. If so, can you comment on how much freight is moving on the spot market in 2019 relative to 2018? Do you have any data on that? My hunch is the volumes are much lower this year on the spot market since most carriers locked in much higher rates a year ago in their contracts. and shippers were happy to lock in the capacity in their contracts so they didn't have to chase it in the spot market.
Yeah, we actually don't get a lot of data on spot market. So most of our data is what you would call the quote unquote contract market, which I personally hate that term because it's neither contracted nor is it something you could sue somebody over, which is really what it means. If you look at committed, so the vast majority of our data is committed. Now we do have a partnership with DAT for spot. And so we do point some spot lanes out. But if you look at the quote unquote contract business, the way we sort of drive intelligence to it is the electronic tenders, the request for loads, the 214s and such. And so that's how we're driving sort of volumes in the contract or committed market. And it looks like it's showing strength. As it relates to spot, DAT is saying that they're seeing more activity on their marketplace this year. They did see some slowdown earlier this year, but I've seen that sort of come back. Now, what I don't know is how much of it is shifting between the quote unquote spot market and how much is the contract market. It's very hard to get access to that data and sort of derive all your sort of conclusions to it. I think, frankly, as you look at DAT's volumes, they're showing some level of increase in terms of year over year. I believe they reported that. We're showing 4 to 5% level of increase. And again, ours electronic transactions are committed business, if you will. And so we certainly believe the market is strengthening. Again, we're not driving a lot of data from the spot market. As it relates to rates, frankly, the spot rate leads the contract rate, if you will. I mean, it is a fact that if you have, and we've studied this, is if the spot rate stays, I think it's within 20 cents a mile or more lower over, I believe it's 90 days. I have to go back and look at the data. I think it's 90 days. Then you'll see shippers will start to reallocate a portion of the capacity towards the spot market. And then the opposite is true. If the spot rates shoot up above the contract rates, then carriers will start to shift capacity in that direction.
Great. And maybe just a couple more here. Do you have any insight on the future impact of the California AB5 ruling on independent contractors?
Yeah. I mean, no. Other than what we've covered in terms of what it means, I mean, certainly trying to predict California politics may be more difficult. And actually, it's probably easier because it goes in one direction, it seems like. But, look, I think, frankly, the independent contractor ruling and independent contractor status is under attack from really everywhere. At least the very liberal states, and these are states on the coast, or even places like Michigan and Illinois. And I think that agent model or independent contractor model is probably going to be under a significant amount of pressure. I think this has been covered pretty well by the press. I don't know where it ends up because, frankly, a large portion of California's growth in their economy is related to the tech sector, and the tech sector has really endorsed the independent contractor model, and it seems to be sort of they seem to be really comfortable with that. And so I don't know. I mean, it's something to watch. It's something to be concerned about if you have independent contractors.
And we'll take this last one. Is there anything you're seeing in the freight market today that you feel like no one's talking about or paying attention to that maybe they should?
I mean, we cover so much of it, so we're talking about a lot of this stuff. Right. I think it's a great question because I don't know that I have an answer. I mean, I think one of the things that, again, I've been challenged about, and I touched on a few minutes ago, is the question of what is the impact of these new marketplace models, the Uber Freights, the Convoys, these digital brokerage apps, the JB Hunt 360s. Are they actually creating substantial amount of pricing pressure in the spot market? And I don't know that we've explored it deep enough. I mean, collectively, they're probably $3 billion. They represent effectively 5% of the spot market volumes. And so do they have are they significant enough players yet where they're showing pressure on pricing and price ability for carriers to get rate increases? That's a good question. And maybe we'll have to leave that for our research group to figure that out.
That sounds great.
So
awesome. Well, thank you guys so much for taking the time to tune in today. We appreciate it as always. And thank you so much to Craig and Anthony for being here today and sharing your insights. If you haven't already, please go ahead and get your tickets to FreightWaves Live in Chicago. It's taking place November 12th and 13th. Ticket prices, I believe, go up.
Yeah, October 1st, tonight, which I actually thought there was 31 days. There's not. There's 30 days. So I've already made that mistake today. So
you can visit FreightWavesLive.com to get your tickets and learn more about the event and the agenda. We hope to see you guys there.